Within this video, we're going to be looking at Unit 2, Topic 2, which is all about savings and investment products. As part of this video, we're going to look into why people save or invest, the differences between savings and investments, providers of savings and investment products, and also the types of savings and investment products. At the end of the video, we're going to assess our knowledge with 3 multiple choice questions. So, why do people save or invest? Well, generally for 2 reasons. The first reason is for capital growth. This is where money works for you essentially and grows over time. You're buying now and selling later, hopefully making a profit in the process. So the underlying value of your money will grow over time. The second reason is for income, and this is when an individual saves or invests to give themselves an income over time. So this might be a weekly or monthly or yearly income. The investment, therefore, will supplement their income potentially from a job. As part of this, it's worth considering that some types of income are earned, where others are unearned types of income. An earned type of income would be from a job or career, whereas an unearned type of income would be from investments. So one is not actually doing anything to earn that income apart from investing their money. Another type of unearned income, of course, would be winning the national lottery. Now, savings versus investment. What is the actual difference then? Well, a lot of it comes down to risk versus reward. When we're putting money into a savings account, we're putting it into a relatively low risk option. Of course, the FSCS, the Financial Services Compensation Scheme, guarantees an individual's savings up to £85,000 in each account. Whereas with investments, it is particularly more risky. These sort of things, and we'll come on to that in more depth later, include things like investing in stocks and shares. Whereas with savings, it is highly likely that your money will be safe, and therefore when you come to withdraw it, it will be able to be withdrawn. With investments, your money is not guaranteed to all be there when you come to take it out of the investment. By that, what I mean is your investments can go up as well as down in value, and therefore the inherent risk is that much more with investments. That said, generally, if we're willing to accept more risk, the rewards are potentially more higher. With savings accounts, because it's guaranteed, the reward is significantly lower than things like unit trust or stocks and shares investments. So who provides these savings and investment products? Well, firstly, banks. Building societies also offer a number of different savings and investment products. The NS&I, or National Savings and Investment Bank. This is generally known for a range of different savings options, but generally mostly known for their premium bonds. And also brokerage firms. These are firms which essentially arrange deals between buyers and sellers of various different investments. So for example, Plus 500, Hargreaves Lansdown, Trading 212, these are investment brokerage firms essentially, whereby buyers and sellers meet in order to exchange different investment products. So, what savings products are there then, and what options are there for people who want a low risk savings account? Well, firstly, fixed term savings accounts are a good option. These are where individuals will put their money into a particular account and lock it away for a certain time period. Different organisations may offer a year savings account, 3 years, 5 years even, and essentially the saver agrees that the bank or building society or other provider is able to keep that money for that period of time. These fixed-term savings accounts generally come up with a higher interest rate than instant access savings accounts. Of course, the reason being because that money is, in theory, locked away for that time period. Of course, it's not always the case that it will be locked away and you cannot access it for that specific time period. It may be that if you choose to withdraw your money before the fixed term elapses, your interest rate may go down. The other option for savings products is the National Savings and Investments Bank, and these offer premium bonds. This was an organisation set up on behalf of the government many years ago in order to make saving more attractive. They were worried that people were not saving for their retirement and therefore wanted to encourage more people to put money into savings. And therefore they released premium bonds. These are essentially where an individual can put money into the NS&I bank and in return they get a code. Essentially a bit like a lottery, but for each pound that you invest, you get one code, and that code doesn't just last the week or the one particular draw like it would with the lottery. It actually lasts forevermore until you, of course, withdraw your money. And that means you're entered into the draw each and every month, and the potential amount you could win through premium bonds is up to £1 million. So it's a significant incentive to put one's money into premium bonds. And actually this is a very attractive option for people who want a bit more of an exciting savings option. It's worth noting, however, the maximum at present, and this could be subject to change, but at the time of filming, the maximum amount an individual could put into premium bonds is £50,000. Now we come on to investment products. As we mentioned earlier, investment products are inherently more risky than savings products. The types of things that we're going to be taking a look at is things like stocks and shares ISAs, corporate and government bonds, as well as investing in property. And when we come on to looking at investments, we've got to note the different relative performance of investments compared to cash. Of course, we have this table in front of us which tracks the difference in return from shares, bonds, and cash. The amount invested in cash would mean that, well, over that period of 20 years, it would only increase in value a small amount with the interest paid on cash accounts. If we invested in government bonds or corporate bonds, you can see there a significantly improved return compared to keeping our money in cash. The highest performing out of those three options, however, is shares. Investing in shares back in 1990, potentially £15,000 worth, would mean in 2010, 20 years later, that value of those shares would be over £100,000, and of course increased 10 or 11-fold over that time period. So you can see there, yes, it is more risky. As you can see, the purple line is fluctuating somewhat, especially after things like the financial crisis of 2008. It dipped significantly, whereas cash and bonds are more of a steady incline. Another graph here looks at the total return of US stocks, bonds and gold, and this is over a much longer time period, 1871 to 2017. You can see gold, actually it only started increasing in 1935 or so, but gold has increased, yeah. Also, US government bonds have increased as well, but the S&P 500, which is a stock exchange over in the States, that initial investment of $100 would now be worth over $10 million. So you can see once again, yes, it is potentially more risky. You can see the fluctuation after the Wall Street crash of 1929, significant dip, and there's other dips, of course, like the one after the financial crash of 2008-2009. However, overall, investing in investments is significantly more rewarding, potentially, compared to keeping savings. So, let's have a look at different investment types. First of all, let's look at stocks or shares. What are they? Well, a stock represents part ownership of a company. When you're buying a stock or a share, essentially you are buying a very small portion of a particular company. Obviously, the more stocks or shares of a particular company you buy, the greater your ownership of that organization. So why do people buy stocks and shares, and how can individuals make money from them? Well, through specific trading platforms such as Hargreaves Lansdown, Trading 212, Plus 500, etc., individuals can buy stocks and shares, and the reason they want to buy them is because they hope that if the organisation, the company, does well over time, the stock price will increase, and that means that at a particular point in the future they can sell that share for a greater amount than which they bought it for, thereby increasing their capital growth. At the same time, individuals may choose to invest in stocks and shares for dividend payments. Now, what these are, if the organisation makes profit, they may wish to divide some of that profit up between their shareholders, and that is known as a dividend. You can see the first 6 letters of dividend. This is the way I remember it, at least. Dividend is when they divide the profit and pay it amongst their shareholders. So a dividend payment, and many organisations, many companies pay these out yearly or bi-yearly, can provide a source of income for investors each year over the long term. So 2 ways to make money from stocks and shares. Dividends, however, when we do receive them, as this is taken directly from the government website, are taxed, unfortunately. You will pay tax on dividends that go above your dividend allowance in a particular tax year. Now, at the time of filming, there was some proposed revisions to the dividend allowance. Legislation will be introduced in autumn Finance Bill of 2022 to change Section 13A of the Income Tax Act of 2007. The change will reduce the amount charged at the nil rate, so that is the amount that one can earn from dividends without having to pay tax, from £2,000 to just £1,000 from the 6th of April 2023, and then to just £500 from the 6th of April 2024. So of course that has meant it is less beneficial to take income through dividends, because of course with the nil rate allowance changing or decreasing, it means that we have to pay tax on a smaller amount of dividends. The second investment that we're going to look at is commodities. Now, buying commodities is buying things like gold or fine art or indeed rare watches. These are commodities, these are items that we may wish to buy, which we hope will go up in value over time. But it's important to note that only some of these increase in value over time. They may, of course, lose value over time as well. What does it depend on, therefore, whether an individual should invest in commodities or not? Well, personally, I would only invest in commodities that I have good knowledge on. And, for example, fine art or rare watches, I have no knowledge on whatsoever. So it's something that I would avoid investing in. But if an individual has a particular knowledge of a specific commodity, then they are in the best position to be able to judge whether that particular commodity will go up in value or not. We're going to look now at gold and the gold price over time. Now, gold has both aesthetic appeal and practical appeal, for it is used, of course, in various electronic items. We can see the gold price and how it's fluctuated over time. Back in July of 2018, you could buy a kilogram of gold, or the commodity, for about £31,000, roughly. Of course, in January 2023, that same kilogram of gold would be worth £50,000. So you can see there a significant increase, and that is just over 5 years. So from 31,000, it has gone up 2/3 to 50,000. So a significant increase and significant, especially when compared to savings accounts. But as you can see here, there is fluctuations in the price of gold over time, and therefore it would be wise to only invest in these sorts of commodities if one has a specific understanding of how the market works. Let's come on to ISAs now, and ISAs stand for individual savings accounts. They are exempt from tax on returns. That is a major benefit of an ISA. There are limits, however, on the amount an individual can invest in ISAs each year. Of course, the government doesn't want to make it too beneficial for an individual. They want their tax. And in 2022-2023 tax year, the allowance was £20,000. But it's important to note that ISAs, which are generally offered by banks and some building societies, can either be stocks and shares ISAs or cash ISAs. Now, a cash ISA is simply when you deposit money, of course up to £20,000 in the current tax year, into a bank cash ISA, and that bank will pay you an interest rate, a set interest rate, over the tax year. On the flip side, ISAs can also be stocks and shares ISAs, which is when individuals can deposit up to £20,000 with a particular bank or building society, and that bank or building society will invest their money in stocks and shares on that saver's behalf, and therefore the potential stocks and shares ISA return will be that much higher than the cash ISA return. However, it is not guaranteed, and that is very important to understand when choosing between stocks and shares ISAs or cash ISAs. I've done a separate video on Unit 2, Topic 1, and within that we look at risk versus reward. So it's important to consider how risk averse an individual is before they decide whether to invest in a stocks and shares ISA or a cash ISA. Next, we're going to look at bonds. Now, what are bonds? Well, they're long-term loans made to large organisations such as corporations, companies, or to governments. Borrower, the government or the corporation in this case, promises to pay the bond back on a certain date. So you or I may wish to loan money to a large organisation, and that organisation agrees to pay our bond back at a certain date. Until that date, in the meantime, that borrower will pay pre-agreed interest payments to the bond holder. So each month or year, up to that certain date, you will receive interest payments. These are, of course, considered less risky than buying, stocks, for example, because you get paid a fixed rate of interest over a fixed period of time. And especially when you're buying government bonds, for example, if the government is unable to pay back the initial loan at a certain date in the future, then the government has ways and means of getting that money back in order to pay. For example, they may wish to increase taxes or, of course, issue more bonds in the future in order to pay that initial bond back at a certain date in the future. That means that these, as mentioned, are considered less risky than buying things like stocks and shares. Another opportunity to invest is in property. There are generally two ways to invest in property. Firstly, owning one's own family home. If an individual buys their own family home, they can increase their equity holding within this family home by paying down their mortgage each month or year. This means that if you've purchased a family home and you are increasing your equity in it, you own a greater proportion of it. Now, the hope is, of course, that over time that family home will increase in value. And if we look at the diagram on the right-hand side, which is taken from the BBC website and was initially produced by the Office for National Statistics, we can see that the average UK house price back in 2006 was around £160,000. In 2021, it was up to £256,000. Therefore, owning one's own family home is beneficial because it's highly likely, of course, there will be fluctuations along the way, but it's highly likely that house will increase in time over time. The other option, of course, is buy-to-let property. By buying buy-to-let property, you're buying a property but not actually living in it yourself. You're buying it in order to rent out to other individuals or families. And that means you can benefit twofold. You can benefit from the increase in the overall capital value or the property price over time, but you can also benefit from renting that property out. Those tenants will pay you rent each month, and therefore you will not only benefit from capital growth, you will also benefit from an income. Of course, that will be subject to tax, but nonetheless, great ways to invest. Next, we come on to investment funds. These are where individuals pool their investments into a fund, and a fund manager invests those individuals' money on their behalf into certain things such as shares, bonds, commodities, cash, or indeed property. The benefit of a collective investment fund is that the idea is it's run by an expert, a fund manager, who will invest individuals' money on their behalf in certain investments. The idea, of course, being that because it's run by an expert, the return is going to be that much more. However, it's important to note when we are investing in an investment fund that, like all investments, the value of the investment can go up or down, and also there are likely to be associated fees with the investment fund. These might be things like management fees or commissions, so it's worth investigating what fees there will be in different investment funds. Another opportunity for investment or savings is annuities. These are a contract between you and an insurance company, and the contract requires the insurer to make payments to you either immediately or in the future. Sounds good, doesn't it? Well, annuity plans offer fixed amount of money for the rest of an individual's life, either immediately or in the future, and are funded through either a lump sum or paid for through installments by an individual. So an individual will take out a contract with an insurance company, and they will pay installments to that insurance company, or they can choose to make a lump sum payment to the insurance company, and that organisation will therefore guarantee payments to that individual either immediately or throughout an individual's life. This, of course, can be hugely beneficial to an individual if they want to guarantee a fixed income for the rest of their life or for a period of time. Pension plans are a great option for saving for later on in life. The Pensions Act of 2008 makes sure that every worker in the United Kingdom has a chance to save for their retirement. Every employer has to give workers the opportunity to join a workplace pension scheme, and the pension scheme that the employer offers to workers must be either the National Employment Savings Trust, otherwise known as NEST, or better. Now, pensions are a great way to save for retirement. An individual makes payments through installments to their pension provider, and at the pension age, which is currently 66 within the United Kingdom, that individual can then draw upon their pension. They may be offered it in a lump sum as well as monthly amounts, or simply just monthly amounts. Now, the state pension is the pension which is offered by the state itself. and it's actually increased significantly recently. The state pension increased by more than 10% in April 2023. Each year, the increase in state pension is determined by something called the triple lock, and this is a guarantee that payments will increase in line with whichever is the highest of the following three, whether it be the Consumer Price Index measure of inflation, average earnings between May and July, or 2.5%. Of course, at the time of recording, we're going through a stage of very high inflation. So therefore, the triple lock meant that payments increased with the CPI, the Consumer Price Index measure of inflation. So it was actually over 10% that pensions increased. So what is the new state pension? Well, the full rate of the new state pension will be £10,600 over the year, or £204 a week. But what you will get could be more or less depending on your national insurance record. So in order to claim the full state pension, individuals need 35 years at time of recording of national insurance payments. Now this will equate to them gaining £204 a week, or £10,600 over the year. That is a pension provided by the state, but of course maybe individuals have private pensions such as the Nest, in which will supplement their earnings in later life. So let's test our understanding of Unit 2, Topic 2 with some multiple choice questions. The first one is, which of the following is not an investment product? An A, a notice account, B, a stocks and shares ISA, C, corporate bonds, or D, property. If we're unsure what the answer is, it may be worth crossing off options which you definitely know it isn't. So for example, in this case, we may wish to cross off investment products. So D, for example, investing in property is risky, so it's definitely not D, for example. That will give us less options from which to guess. So of course the option which is the correct answer for question 1 is A. A notice account is not a type of investment product. So a notice account is a type of savings account whereby a saver has to give notice to the bank or building society that they wish to take money out. The second multiple choice question is, what is the annual adult ISA allowance for paying into a stocks and shares ISA or a cash ISA? Is it A, 10,000 maximum, B, 20,000 into a cash ISA only, C, 20,000 into a stocks and shares ISA only, or D, any combination not exceeding 20,000? The answer, of course, is D. Cash and stocks and shares ISAs can both be invested in any combination up to a maximum of 20,000 per tax year. Before we go on to the third multiple choice question, remember I've done a full video looking at 3 full specimen papers for Unit 2 multiple choice questions. I'll leave the link in the description. Question 3 is, Bonnie has invested $3,240 in a cash ISA during the current tax year. What maximum further amount can she invest in a stocks and shares ISA in the same tax year? Is it A, 3,240, B, 5,000, C, 6,480, or D, 16,760? The answer to question 3 is D. The annual ISA limit is £20,000 and it can be split across a cash ISA and a stocks and shares ISA in any combination. Therefore, Bonnie can invest a further £16,760 in a stocks and shares ISA in the same tax year.